So today we're going to talk about something that is extremely important: revenue management within a value add system. Now, there's a lot of confusion about revenue management. I think a lot of people assume that you have to have a very expensive software system and that you have to have a lot of knowledge to do this. But really, we want to boil it down into this video in a manageable way so that even individuals just starting out can have extremely effective revenue management. This is the key. So before we get there, let's talk about the fundamentals, right? Let's talk about why revenue management is necessary and how revenue management not only changes your asset, but your valuation. Remember, self-storage facilities are based upon revenue, right? We value them off a cap rate or their net income. It's how much return that investor is going to get. Revenue management, you have lots of doors, and it's really a key aspect because the pricing in storage facility can vary a lot. You can have storage facilities across town, right, or even right by each other, where a 10 by 10 is totally different prices. This is common in self-storage. It's not like apartments, for example, where quality and price, depending basically anywhere in the city, are generally the same, right? That's just not how it works in self-storage, and hence the opportunity, because you can buy a storage facility, increase rents, and manage the revenue. Therefore, you will increase your net income, and your price or valuation of that storage facility can explode. This is an absolute key into how we've been so successful. And the bigger companies get, they use extremely technical software. Now, we didn't have anything like that, and really we kind of don't use the big boy software. It's still manageable for us in our finance department, right, and our underwriting to do it ourselves. In fact, there's some things that we actually think are advantageous to doing it ourselves, and I'll explain why. So, first of all, how are rates determined? Well, really, let's just boil it down to supply and demand, okay? So supply and demand is going to dictate how much you can charge, right? And that is determined by the marketplace itself. Every marketplace is different. And really, you can charge, theoretically, infinitely if people would allow you to. Also, though, if there's way too much supply and there's no demand, it doesn't matter what you charge. You couldn't give away the units. This is important to understand because this depends on whether you will be successful or not, right? The supply and demand winds at your back will either carry you forward or they'll kill the investment because there are none and there's nowhere to go with that investment. So supply and demand in self-storage is everything, as in any business. But supply and demand is particularly sensitive in storage because of the reason that it's a box. It is what it is. To some aspect, right? Storage is a commodity. And this is very much misrepresented in the marketplace because there's markets that have huge demand, but storage facilities that don't raise prices or are completely uncompetitive in the marketplace. And this is where your opportunity is, right? This is the value add system we're talking about. In fact, that's the system that we use. We buy underperforming facilities and we turn them around. And there's a few things we do, but revenue management, dynamic pricing of those units, meaning those prices change, that is fundamental in our process. And that operations, or that mode of investing, that still exists everywhere. We can still pull this off all the time. In fact, we just bought a $6 million facility whose value add potential is huge. In fact, we believe we can double it. Why do we believe we can double it? It's not because we wrote it in a nice spreadsheet and it looks great, but because the rates on that asset are half of what's going on just a mile down the road. And the product is exactly the same. It's almost like arbitrage, right? We can increase the price and you're not changing the value for the customer at all. There's no differential. Yet the price of the asset doubles. So that's all good and well, but how do you do this? How do you take a small facility, let's say if one $500,000 facility, maybe it's 10,000 square feet, maybe it's 50,000 square feet or 250,000 square feet. You're like, I'm not a sophisticated operator. So how do I do this? Yes, there is the option of hiring third-party management, and they can take care of everything themselves. Or you may say, I want to learn, and I don't want to give that money up to a third party. I want to do it myself. So how do I do it? Well, let's get into some really basic things that you can do to completely change the value of your facility and the money coming into your pocket. All right, so the first thing we talked about was supply and demand. Now that seems simple and very fundamental, but for some reason people aren't actively engaged in really seeing what the demand is, and that doesn't reflect in pricing. Now, the first thing and the main reason for this is the lack of individual pricing. What does that mean? That means that when you look at a market, or let's just drill down into an individual asset itself. Let's say you go to a facility that you're wanting to buy, and you ask, how much is a 10 by 10? Our 10 by 10s are $100. Well, what they do is they classify it as an individual product, and all the products are the same. Actually, they don't classify it as individual. I'll get to that in a minute. But they classify it just the same thing. So they got 100 10 by 10s, and all of their 10 by 10s are $100. This doesn't make sense at all for a few reasons. First of all, that person that's coming in, the value of that 10 by 10 versus another person a year prior or a year in advance, the supply and demand is totally different. This depends on your vacancy at your facility in the market. How much have you filled up? If you have a facility that 10 by 10s are 95% full, does it really make sense that the demand for that unit is the same as the first person that rented that 10 by 10? No, demand is totally shifted, right? Now you only have 10 units, where before you had 100. Demand is increased, but their pricing doesn't reflect that increase. Keeping it simple, when you buy a facility, not everyone should ever receive the same rate. Focus on individual pricing. And here's how you do it. All right, so the key to individual pricing is to realize that you need to have tenants on a schedule. They need to be on a rate increase schedule. Now, something you may not realize, but we don't have long-term leases, and that's a benefit in self-storage. Why is that a benefit? Because every single month across my portfolio, people are getting rate increases all the time. Literally every day that I woke up, someone the previous day received a rate increase. That means I'm making more money the next day than I was the previous day, and I did nothing. And this is happening now at scale across thousands of units that we have, literally 8,000 units, right? Well, over 8,000 units. So you can imagine, over 8,000 units, people are every single month, all these people are getting rate increases, which is dependent upon their own schedule, nobody else's. This helps you in two ways: the consistency of increasing revenue, but also the lack of risk of people all moving out at once. And I see facilities do this and they get burned, and so they stop giving rate increases. Because what they do is they say, all right, those 10 by 10s that were $100, this year we're gonna give all the 10 by 10s, we're gonna give them a 6% rate increase because demand's going up. They give that 6% rate increase, and out of 100 people, 20 of them complain, and they blow up the phone and the email of the operator. The operator's totally taken back by this. He's taken back by this for two reasons. Because it wasn't an individual scheduled rate increase, they weren't used to it. Some of those people had been sitting there for a couple, 3, 4 years and hadn't got a rate increase. You trained them that there's never a reason to get a rate increase. Those people have been accustomed to paying the exact same price month after month after month for years. And then you took 100 of them and gave them all a rate increase. They're mad. That's on you, not on them. Individual rate increases, 6 to really 12 months. You should never go over a year. Every individual will be getting a rate increase. We've taken over facilities that we gave a 4% rate increase, and we had to do it across the board because it had never been done, and everyone lost their mind. They thought it was just, everything was tumbling down. It was Armageddon. How could you do this? And everybody threatened that they were all gonna move out. It was the end of our asset, and it would fail. This never happened, first of all, but our manager was bombarded for months, people yelling and swearing at her, being so upset. And they'd come in and they'd say, I've never gotten a rate increase in 10 years. Well, then you should have said thank you, not yelled and been upset that you didn't get a rate increase. It's like, you're welcome. But that's a pet peeve of mine, and I'm not going to get on that tangent. But when we added in active rate increases for every single individual, that means they're getting them every single year and at rates much higher than the 4%. No one ever complains. Well, how can that be? You're giving them every single year now rate increases instead of the exact same facility that had gone 10 years without. Why? Because the tenants now know that that's part of the deal. So they accept it and they move on. Just like every other thing that we have in life, prices go up. That's how the economy works. That's inflation. Well, if you train them that that's not how it works in self-storage, that's all they know. So that's your first thing with individual pricing, right? Is just what you're dealing with. But because they got all those people screaming, the owner says, I'm never doing that again, and they stop. Wonderful opportunity for you to come in, buy the facility, create standardized rate increases every 6 to 9 months, and you price those rate increases based upon the demand in your facility and the demand in the market. The tighter the market is, the more aggressive you can be with those pricings. I don't think we've ever not given rate increases under 6%. It's just traditional. We've come and adjusted some real quick, maybe a 4%, not to make everybody too ticked off, but then immediately everybody's on a schedule from 6 to 12% rate increase, along with 6 to 12%. Well, we've gone a lot higher on rate increases, which I'm going to get into a story here in a minute that's going to blow your mind. But that's standardized. Once you get them on a standardized schedule. Now, we have all these 10 by 10s. You're multiple years down the road. Everybody's been getting rate increases. You have new people moving in, which are coming in at a higher rate, which is your street rate, right? We have two different rates. Now, all of a sudden, you're looking at your revenue, and your revenue has become dynamic. Every month, it's changing. Every month, you're getting more and more value, and customers are complaining less. That is individual rate increase and individual pricing. Somebody that moves in when I'm 100% full should not have the same rate as somebody that moves in when I'm just filling up or there's a lot of vacancy in the market. It's supply and demand. So all these people in our facility, they're getting rate increases, and we're all trying to get them to the street rate, which our street rate, we're constantly moving up. It's also seasonal. So this is something that you can easily do on your own. Any property management system that you have allows you to move someone in and schedule a rate increase. It's not complicated. And as long as you're managing that on your own, and with one facility, it's totally doable by yourself, and looking around at the rates when you do a rate check, right? This is secret shopping. You're making sure you see what all the other competitors are doing, so your rate can continually be moving up. You have a dynamic revenue system. It's like compounding upon itself, building value and net income straight to your bottom line. I can't stress the importance of this enough. And I also can't stress that when people aren't doing that, there's the opportunity. Lots of times, because this doesn't happen, you have people that have been in there for years that are a much lower cost. You have what maybe is their listed price, right? So the listed price of the storage facility you're looking to buy, and that's $100 for a 10 by 10, but you find out that 40% of the tenants are paying $60 or less. Well, that's not really the revenue. And so if I know that the street rate is $100 for a 10 by 10, everyone's getting that in the market, and I can, and 40% of their tenants are at $60 or less, I can immediately buy that facility, increase that way up, maybe just under the rest of the market, put them on individual rate increase schedules, sit back and watch the money come in. This is how individual rate increases should be done. Once again, totally manageable by you. You secret shop the market, you look at occupancies, you look on your occupancy and see how aggressive you can be on those individuals coming in. The fuller you get, the more aggressive you should be on pricing your own units. This is something that we've always done. We do use a software that looks and analyzes on our pricing, but at the end of the day, it's between that and our data and information that we're getting because we're going out and looking at the market that really comes down to how much we're determining what our rate increases should be and our overall street rates, our pricing should be. So the idea, once again, is training your tenants, getting this off your hands, not doing it all broad-based sweep, creating a system that is perpetually growing. One of the big things that you need to do, though, is determine your street rates. Now, this comes down a lot to value, and you need to understand this when looking at the market. Like, what is your value proposition? What I mean is, do you have dirt roads? Right? Is your facility not really up to par with facilities in the area that may be all paved, have indoor, and offer a lot of services? So you need to understand when pricing your individual units and your street rates and how aggressive you can get on what your customers are willing to accept. In some markets, they're willing to accept basically anything because there's just no space. But as markets get oversaturated, particularly with new, better supply, it becomes much harder for you to be aggressive on those rates because now they have options and they may have better options. So when we look at facilities and you're determining on what to buy and how your rate increases can go, your rate schedules, right? Because you want to be active in your rate increases. When I'm looking and determining that, I have to take into consideration my competition. That's very fundamental when deciding rates and rate increases. So when I look at the competition, I have to do a competitive analysis, right? I take all my competitors and I look at their strengths and weaknesses and I look at their overall pricing. But it's important to know how people price units. For example, some of the big competitors, like Public Storage, for example, they play games. Like they'll do a lower price, so it looks like their pricing is really, really low in the marketplace. They get people to move in, and then they're super aggressive. So their street rate is less than their active rate in their facilities. Now, too, if you've ever noticed, some storage facilities you go in, and the managers don't even know what price you even want until they put you into the computer and look at an individual price per unit. That's because their pricing is so dynamic. The storage facility manager doesn't even know until the software tells them what that price is going to be. It's extraordinarily active. For you, when you're looking at your prices and your street rate, it's important to push the limits, but only push the limits, right, to the value that you can attribute to your facility. You want to manage your reputation. So when looking at your facility and managing your reputation, there's a few things you can do. And this is part of the value add strategy that's really important. It's amazing what little updates you can do to a facility but drive extraordinarily higher prices. This is a key component of your revenue management, dynamic pricing, and value add system. The more you can justify those revenues, the less backlash you get. This can be very simple. Update and paint, resealing, make the office nicer because the office is where you give that offer, that value add presentation to your tenants, which justify your prices. Make it look nice, make it look friendly. Update your security cameras, right? If I bought a facility and they had no security cameras and they had gravel, not pavement, and I looked at the rest of the market and there's 30% below the rest of the market, I can go in, pave that facility, add security cameras, and immediately charge close to the higher end of the market. The revenue you get is disproportionate for what you have to put in lots of times. And that's the key. Then as you get those higher prices on your street rates, you get very actively involved in individually scheduling out the rate increases and upping the prices immediately on the existing tenants because now it's justifiable and there's no better time to up rates than right after you've completed a project. Now, let me share some examples with you because these are fun, although extreme. This is very extreme. So we bought a facility and the facility had been owned by the state. Now, this facility's pricing was super low in the market, and it was actually very controversial because the state was competing with private businesses. They didn't have to pay taxes or anything else. And two, the state never put any money into the facility at all. It was horribly ran. And they didn't need to do a lot, but they just didn't do anything. So the office was kind of grummy, didn't look good. We bought the facility from the state. It was roughly $4 million, as I recall. We bought the facility. It was a larger facility, 85,000 square feet. We came in, we repaved it, and we gave a whole uplift to security in the office. We spent $150,000. Now, judging by the asset size and how much it cost, that wasn't a tremendous amount. But just that alone put our offering and our facilities look, feel, security above all the competitors. We immediately, and by immediately, I mean the documents were signed the next day, letters went out, and we adjusted prices to reflect the marketplace. Now that was on average a 67% rate increase. Some people got over 100%, 150, 60, 70% rate increases because there was such a disproportionate rate with the competitors. Now, this is good for two reasons. First of all, your competitors in their marketplace, the other storage facilities, were grateful because now they didn't have this competitor, which was the state, that didn't have the same expenses as them, charging low prices. We upped it to their prices, which stabilized the market and got rid of a bad player. But our tenants had never received a rate increase. And that was a shock to their system. Obviously, they went nuts. And everyone in our marketplace, including our other competitors, were like, whoa. I mean, they were shocked at how aggressive we were. In fact, when we bought that facility, we bought it at auction. We went and had our own individual auditor look at this facility. We had him underwrite this facility. And when we had the numbers come back, we were extraordinarily confident that there was so much demand in the market, we could get that without a lot of people moving out. Now, when we went to go to pay for this, the appraiser of the state had come in and had appraised this at a very low value based upon its rents that it was getting, which was interesting to us because that wasn't reflected in the market. So we had our bank go take an appraiser and appraise it at what we were looking at those numbers to be. Well, our appraisal came in at 7-8 million based upon the market rates. So we knew we could double this facility. We immediately upped prices. Revenues just absolutely skyrocketed. Obviously, we had people move out, but in that tight of a market, we immediately filled up, literally in months. We're upgrading this facility. We stabilized it, active rate management. The facility is worth $10 million today, and within 6 months, that facility was worth $7-8 million. That's an extreme example, but it shows you what's out there. And it shows you that there's a massive disconnect in the market based upon quality and operators. You can do this individually. That facility I'm talking, we didn't have some fancy software. This was us putting in the work, putting in the time to understand the market, understanding demand, understanding supply. And by understanding supply, I mean the quality and the competitors and what they were charging. We came up with street rates, and then we got aggressive on our rental rate increases, extremely aggressive. And obviously people flipped out because they'd never received a rate increase, and we hit them with this huge one. So some people left, other people didn't. But then we piggybacked that with a great marketing campaign in a tight market, filled it right back up, put everybody on active rate increases on a schedule. The revenue continues to rise. It's a wonderful asset that we picked up. This is a prime example of rate management, right? And a prime example of doing individual pricing and how that affects the trajectory. We had a huge pop, but then it went straight up from there because we lifted up street rates. So all those people that left, those were price sensitive people. They're gone. We were encouraging people to leave. Please leave, because I'm replacing you with people that are not price sensitive, and I can put them at a higher street rate and get them on aggressive rate increase schedule. And they're happy to get in because there's no other options. And now we're providing a great product. Remember, there's 3 types of tenants. And this is important because this depends on how you price. All right, so your 3 types of tenants or your 3 customers. First are the price sensitive customers. In my example that I previously gave, it was full of price sensitive customers. The facility didn't have to pay taxes. They didn't have the same expenses, so they could keep artificially rents super low in the marketplace. We find this all the time. Storage facilities that they want to focus on being 100% occupied, having low rates, because when they up rates, they lose customers and they say, I'm not 100% occupied. Well, I will give up 5% of occupancy to get 25% rate increase in revenue all day long. But a lot of operators don't look at it like that. So the first is price sensitive customers. You don't want those. They give you all your problems, right? They are the loudest, the noisiest, they cause problems in the facility, they make the most damage, and they don't want to pay anything. So get rid of those. You focus on the second customer, right? Which those are customers that really care about location. They're very sensitive. They don't want to drive far away to get their product. They want it to be near them. And the third, which is quality. We buy price-sensitive facilities, improve them, and focus on people that care about quality and location. That's really the trick. And the more aggressive you can be with your pricing, the more you can get rid of those price-sensitive customers and bring in the customers that you want or your dream customers. You don't want everybody, so don't try to get everybody. I hope this helps, guys. This is kind of a how-to on do-it-yourself revenue management and why, but it's totally doable by yourself. Remember, we have over 1.45 million square feet at this point. We just bought 2 new facilities. And I'd say 60 to 70% of our revenue rate management, we're still doing in-house. That'll obviously change because we won't be able to, but we still like to be very dynamic on our pricing and very aggressive. We are the price leaders in most of our markets, and it shows in the product that we offer. The higher our prices are, the more revenue we get, the more we can put into our facility and create a better product for the customer and a better investment for us.